want to talk about the Federal Reserve for a few minutes because that's sort of a mystery to most people, just what this thing is, what it does, and what impact it has. Donna talked about taxes and spending. That's what we call fiscal policy. What the Federal Reserve does is called monetary policy. And basically, to begin with, the Federal Reserve, the function is to create a stable money supply in the country. It was formed in 1913 by Franklin Roosevelt as an independent agency, and that's something important to remember. An independent agency is formed by statute. The people that run it, and in the case of the Fed, there are 7 governors who are appointed by the president for a term of years. Once they're there, basically, there's no way to get rid of them. I mean, I suppose if they steal something or if they commit a crime, you can, but unlike a cabinet member who can be recalled, be fired any time by the president, the people that run independent agencies are basically there. Congress can call them up and yell at them, but they don't really have any authority to do anything but to change the legislation or to cut off their funding for certain things, which is what we hope the new Congress is going to do. So the Fed has an enormous amount of power. Among other things, it sets the interest rate that it charges to banks. The Federal Reserve lends money to banks across the country, which banks then in turn lend out to you. So if the Fed says we're going to charge 1% interest to the banks come in, borrow money at 1%, they turn around and lend it to you at 6%, and they make 5% in between. Or they can raise or lower that interest rate, which affects the amount of money that banks will borrow because of the cost of borrowing, and it also affects when the interest rates are lower. Obviously, it's a stimulus to people to borrow money, businesses and so on, to do all the things that they do. The Fed also sets the reserve rates that banks have to keep. In other words, when a bank lends money, it has to keep a certain amount of money in the Treasury in case the loans go bad, so that they can cover them. And the Fed tells them how much money they have to keep. If they keep less money, they have more money to lend. That stimulates the supply of money in the system, and the theory is that's a stimulus to the economy. The Fed can also buy or sell government bonds. When the government is issuing bonds because it's borrowing money, it's increasing the deficit, the Fed can come in and buy those bonds, which it holds. That reduces the money, or increases the money supply because it's spending money to do them, or it can sell those bonds, which means people come in and buy those bonds from the Fed, and then the Fed keeps that money instead of having it in circulation. So all of those things are done to affect interest rates, basically to affect stable money and to affect the growth of the economy. Okay. Now let me talk, I'll come back to this in a minute. I want to talk about something that you've probably heard about, and like me, the first time you heard about it, you said, what in the world is that? And that's something they called QE2. Now QE2 is not a ship, okay? Most people think it was the Queen Elizabeth. It's called quantitative easing, second part. Quantitative easing is one of these bureaucratic terms that they come up with because they don't want to call it what it really is. What is quantitative easing really? It's printing money. And it's the last resort of a government when they have no other options at their fingertips to stimulate the economy. They print money. It's what third world countries, banana republics, always do. It's what Germany did, if you may remember, in the 1930s when money became totally useless, valueless, because they kept printing more and more and more. It meant there was so much money in the system that it had no value whatsoever. Well, in 2008, the Fed started with its first quantitative easing, as it's called, policy, and it didn't really work. They did it again, and they have now, I think, generated I think $3 trillion in money that they've actually printed to stimulate the system to try to control the depression, if you will, or whatever you want to call it, that we were in. It was their way of, instead of doing what Lou talked about, supply side, demand side, but at the last resort, demand side being putting more money into the system basically to stimulate things, instead of supply side, which is giving people more of their own money to stimulate the economy to go out and invest. Well, obviously, the QE, to the first QE, and the QE that hasn't worked, so they've now proposed QE2, which is, over the next several months, printing $800 billion of new money, under the thesis that this will actually do something which they need to do now to try to stimulate the economy. By doing this, they've sort of damaged all the other options that they have. I mean, it's great to say we need to have economic growth, but when you have $13 trillion in debt, which is what the federal government has, it means that the federal government has to pay a huge amount of money in interest. It keeps growing more and more, and incidentally, you may know that the deficit of the United States has doubled since Obama was inaugurated. In other words, it took 2 years to accumulate the same amount of debt for the United States government as it took from 1789 till the present. Just think about that for a minute.